the TheoTrade. This is Don Kaufman. It's May 15th, 2019, and you are watching the TheoTrade evening video. We're just moments after the cash close. The S&P is up some 1350, which is just shy of 0.5%. Nasdaq futures ripping in today's trade, up about 1.3%. And the Russell, well, the only way to describe the Russell, massively unchanged. I mean, come on, 0.3% doesn't even count. I mean, what's really going on today? It's kind of a striking and, if you will, mass divergence in the marketplace. And today's trade, it's all about the Nasdaq ripping to the upside, which is the only way to really describe it. I mean, this morning, it was Mr. Toad's wild ride to the downside, followed by a pop. And there's a couple of tweets that happened in here that, of course, prompted some of this upside potential that the marketplace saw today. Nevertheless, the divergence that we're seeing right now in that market, and this is exactly what I'm going to show you here momentarily, this is what matters going forward. The divergence I'm about to display to you, and this is what's going to set the tone for the days to come. Now, I think a lot of bullish traders look at this as quite a victory. You know, what do we have? You know, yesterday we kind of reversed back to the upside, of course, pinging from the 2811 gravity point right yesterday into the 2842 gravity point. I mean, in today's trade, we touched down almost again to 2811, ripped above 2842, and here we are, you know, coming in again to the cash close right around 2853. So again, a lot of bullish traders are like, victory is mine. Nevertheless, let's get into this divergence. One of the things, as I said, was really striking here in today's trade, the bonds, unstoppable force to the upside. Now, for those of you that have tuned in time and again, you'll know that I do look at bonds quite extensively, and pretty much that recent low inside of the bonds is right here, which effectively happened, it's almost a month ago, The bonds, for the most part, they really haven't downticked at all, right, inside of about the last month. And as bonds uptick, and if you're not comfortable with bonds, of course, you can look at notes. If you're not comfortable with bonds or notes, because people don't necessarily read ticks, right? Ticks, 24 ticks. What is 24 ticks? It's 3/4 of a point. There are 32 ticks to a 1-point move, but yeah, this is like, and it's fractions, right? It's old Spanish galleon times. If you're not comfortable with that, you can cruise over to the TLT. It's going to be a very, very similar chart, right? So you look over to the TLT, there just hasn't been really much of a downtick in the last month, which actually brings us to the interest rate that's associated, When I talk about interest rates, this one should be pretty clear. Although, I'll tell you what, it's kind of weird the way they denote this. If you look at the quote, it says 23.79. What 23.79 really equates to, is it's the 10-year interest rate. It's 2.37. So it's 2.37%, and that is on a 10-year. If you take a look at like the 3-month, all right, the 3-month is somewhere around like 2.42. So effectively what we have is a yield curve. And a yield curve, it's inverted. What that effectively means is short term versus long term, right? The short term, I mean, if you were to put your money in a bank account, they'd pay you more on the short term than for 10 years. And you're like, how could that be? I'll tell you how it can be. It's called the Fed, It's the Fed effect. Well, the yield curve is inverted again. And this is exactly what we've been barking up this tree now for the last couple of weeks. And I have to tell you, a 9-month chart doesn't do it when you look at interest rates. You've actually got to go out. Here's like a 3-year. When you start looking like a 3-year chart, you're like, wow, this thing could go a lot lower. I mean, the interest rates could go a lot lower. The yield curve could invert even more. And I'm telling you, the entire narrative in the marketplace has been about China, trade war, Today, actually, part of the narrative switched over to like European, trade war, which they've received a little bit of a stay of execution in terms of the tariffs on European imports today. It's one of the reasons the market spiked. Nevertheless, that narrative is, I believe, going to change. And the narrative, once again, is going to go back to yield curve inversion. And the moment we start talking about yield curve inversion, then the R word is going to come back up. They're going to be like, does this mean we're actually going to head into a recession? And again, you're going to start to hear quite a bit of this rhetoric. And, listen, I'm actually going to show you what I talk about with this kind of mass divergence. I'm also going to show you one other interesting thing that you may or may not be aware of that's changed drastically in some of the recent trading days. And that has everything to do This is the CME group, so Chicago Mercantile Exchange. They have a Fed Watch tool. If you take a look at probabilities, I've been showing this a lot lately because the probabilities, why are they in motion? If you look, this is where current Fed fund futures rates are. It's 2.25, 2.5. Let's just call it 2.5% is where the Fed fund futures are. That's the rate that the Fed influences. Well, just a few weeks ago, okay, there was like 100% chance that there was not going to be a cut in rates. Now, there's not even a 50% chance, okay? Meaning that they're actually pricing at a 41% probability they cut by a quarter point. There's a 10% probability they cut by a full half a point. That's a live meeting, meaning that the meeting in September, it's live now, okay? We're just talking the end of summer over here where they're going to cut rates? I thought the Fed said they weren't going to touch anything. Didn't they just say that at their last meeting? Yes, the market doesn't believe them. The market right now is actually pricing in an economic slowdown over here. And this is very, very disconcerting because you go out to the October meeting and they're saying they're going to cut. They're saying the probability say we're going to cut. Now, obviously, this can change. But when you start seeing 75, 80% chance of a cut coming in December or even January, I think you have to start to believe that. Now, with that cut in interest rates, what effectively it's going to do, it's going to put the hammer on the financials. And the financials, here's your wild divergence. The financials, they're just getting tagged. Now, initially when interest rates started to go lower, when those rates started to go lower, the financials were kind of unimpeded. The financials really started seeing the sell side activity, though, right at the beginning of the May. This is the last 2 weeks. And here's the interesting irony, because we're talking about this mass divergence. I kind of call it a tale of two totally different markets, right? Financials, and you have to pay attention to them as they head down. This 2650, this is the line in the sand. This is our Maginot line in the entire marketplace, okay? If the financials cross below 2650, it's bearish for the entire S&P 500. Plain and simple. We've seen this again and again and again, and I've got to back up, and that's why I was on a 3-year chart, okay? You can back up into what? You want to come back into 2017. This right here, the XLF, determined, okay, whether the full-fledged S&P 500 was bullish or bearish at those particular times. We can actually point back to October when we actually dropped into what we termed the volatility box, and really in December, okay, where the financials, they were way ahead of the curve. I mean, the financials were getting whacked hard, okay, well before the rest of the marketplace was getting hit. Again, this is going all the way back into September. The rest of the marketplace didn't feel the pain, of course, until October. The financials, they were already kind of, down, getting whacked prior to that. Again, the exact same thing was true, of course, in the December timeframe. Nevertheless, here the financials are again, and we are at that kind of Maginot line. This is make or break. If the bonds continue, okay, to creep higher, even ever so slightly, that's it. You're going to stick a fork in it. This marketplace is going to be done for the time being. So even though we have this bullish bias, this bounce back to the upside in the last 2 trading sessions, you're not seeing that bounce follow through inside of the XLF. Effectively, okay, what's driving, okay, the markets today were these wild pops in a handful of the big monsters of tech. When I talk about the monsters of tech, what am I really talking about? Well, Google. Google has seen nothing but downside. I mean, listen, Google hasn't had an uptick pretty much since their earnings announcement all the way at the end of April. You can't make that one up, right? There's no uptick pretty much in here. This thing gets slaughtered, okay? And finally, rebounds today by the tune of 4%. You want to know what's driving your marketplace, people? It's right there. And right behind it is Facebook. And Facebook, it's the exact same thing. Facebook has not had an uptick since its last earnings announcement. So what do we get? This is the quintessential kind of dead cat bounce. Whether you want to look at Facebook, whether you want to look at Google, let this play out for a day or two, because I think we're actually going to get some wonderful short opportunities in here. I mean, yeah, I could see Google coming back easily to 1200 or even 1220. What's great, though, is there's no earnings out here. This is going to be a nice, clean, bearish in-out spread that I'm going to select either in Google or Facebook. I got to tell you, though, I'm kind of salivating to want to short Facebook. I mean, who doesn't want to short Facebook? Huh? Come on. But Facebook, I'm going to have to let it come up a little bit more, probably into the 189, 190 handle before I start to step in. And when I do step in, I'm going to be using something like an in-out spread. Now, again, I'm referencing what? The financials and this big divergence in the financials versus, of course, technology. So capital today, I can't say it was flowing out of the financials, but the financials are absolutely in trouble after having touched down. In fact, if you want to look at this, they touched down literally to 2650 before kind of rebounding. And that rebound was all about a tweet. I mean, it was literally, we're one tweet away from a pop back to the upside. Nevertheless, we expect that the bonds and the financials are going to take center stage in the very near term in this marketplace. The other kind of cautionary tale that I'm going to give you, because everybody wants to sound like it's all clear, you guys can come out of the woodwork again, the volatility is over. Well, listen, that sounds great, but look at the overnight range into the trading range here. When you're getting like 45-point ranges inside of the S&Ps, I don't know about you, but I'm not really comfortable sounding the all clear. In fact, when you start looking at the SPX, which, again, I use the SPX on a day-to-day basis for what? To gauge risk. Okay, if you look at the SPX had about a $54 expected move, and we've already moved outside of that. We bounced back inside of it. If you take a look at the Friday options, we're still sitting in about a $30 expected move. Well, once again, that $30 expected move seems a little small to me because today, what? We've moved already $45, from absolute low to high. Now, the last thing that I'd point out is that volatility, it's come down a little bit, okay? It's come down a little bit, but we're still in a highly guarded stance in terms of volatility. I mean, the VIX, picked its head up above 20 for a brief and fleeting moment. We've dropped back down to the mid kind of 16 kind of range. Nevertheless, there's a lot of volatility indicators, people that have not really backed off all that much. One of them being the VVIX. It's right back down where it was, earlier this week. On Friday of last week. So effectively, okay, we're not ready to sound the all clear in terms of volatility. Some very key areas, okay, are still weak on a relative basis. The advanced decline line on a trading session like today, well, first of all, here's sectors. Again, when you've got financials down, it's kind of hard to stage a broad-based rally. But when you start looking at like the S&P 100 advanced decline line, does that scream wildly bullish? Absolutely not. Again, today's rally is brought to you by a handful of massive market cap that simply has just not had an uptick, okay, day in and day out. We're looking at that as a bit of a dead cat bounce. There's a lot to think about, but also a lot of opportunity that's going to be coming here, again, throughout the remainder of this week. Listen, this marketplace, some real volatility is still right there. Stay tuned. Again, lots of trades we're going to be doing here in the TheoTrade chat room. Have a wonderful evening. Bye-bye.